What is a derivative? A derivative is a type of financial contract whose value is derived from an underlying asset. For example, in a restaurant, the value of orange juice depends on the price of oranges. Now, replace oranges with financial assets and juice with derivatives. Value of derivative contract changes based on the value of its underlying assets. In financial markets, the underlying asset can be interest rates, shares, bond rates, properties, commodities, currencies, and market indexes. What is the use of derivatives? Derivative markets are mainly used for hedging and speculation. A hedge is an investment position with the intention of reducing the risk of adverse price movements in an asset. And speculation on derivatives is motivated by profit, rather than a desire to mitigate risks. What are common types of derivatives? There are 4 common types of derivatives: forwards, futures, options, and swaps. These types decide different terms and conditions of the contract. Out of these 4 derivative instruments, forwards and swaps are traded over the counter, meaning these contracts can be customized highly with the party's needs and are not watched over by an exchange. In contrast, futures and options are standardized contracts with quantity and expiration dates decided by the centralized exchange with periodic settlements, and that's why future and options are generally traded more by retail traders. What are the risks in derivatives trading? Over-the-counter derivatives have a higher risk of default by counterparties. Derivatives are highly volatile and leveraged, so unreasonable speculation may lead to huge losses. How are derivative contracts settled? In most cases, the derivatives are cash settled. That means cash is paid from one party to another at the end of the contract. And in some assets like commodities, there can also be a physical delivery of the asset.